out live and we're getting the reminders. All right. What's up, everybody? Happy Sunday.
Hello.
Just finished up watching some of the golf. What day is it? Is
Middle of March already, guys.
yeah.
Where's the time going?
I hope nobody else is looking to close it in March because it's a tight month.
I'll wait till people get on here. No, but you're fine.
Maybe.
Hello. What is going on, everybody? Alrighty. Hope everybody's enjoying the beautiful weather that we have today. We are going to be getting into talking about some assignment deals today.
Mm-hmm.
We're talking about assignments. We'll be talking about how they work, some of your options for them, when you might see them, and maybe what the best way to structure them are going to be. We'll just wait for a few more people to get on here.
5 or 6 people on Instagram there. Nice. Very nice.
If you guys have any questions, obviously, feel free to jump on and ask some questions as well.
I think one reason why we wanted to touch on assignments today is just we've had quite a few come in the last weekend. It's very tricky to find A-side lenders. I mean, A-side lenders who will do variable rates for one, but A-side lenders who will do assignments at all on the rental side.
Yeah,
seems to really have been shut down. And I think a few of the lenders and BDMs I talked to said, the last few months to the year, last six months to the last 12 months, they've really cracked down on these assignments. And it's really just an upper management decision. They haven't really given much of an actual reason. I think a lot of it just has to do with risk. A lot of it has to do with just lenders and banks being slow to keep up with the pace of, the investing world and how creative and just some of the tools a lot of these investors are using. And that's something that we've seen, with assignments. That's something that we're seeing with vendor takebacks. That's something that we're seeing
just in the market in general.
Yeah, just like Josh said, stuff overall. Airbnb. These guys are just, it's an old man's type game, and they're just slow getting around and keeping up to date with, like I said, some of the more creative solutions.
Yeah. So I think one of the reasons why most of the banks are actually shying away from assignments for rental properties has to do with the transaction not being able to prove an arm's length transaction. So at the end of the day, if these assignment deals are being purchased in a corporation and being sold to yourself, there are worries that it wouldn't be at an arm's length, and you'd be hypothetically just selling it to yourself or having somebody inside selling it to you, making a profit. So there are a handful of reasons why most of these banks are shying away.
And it's frustrating. It's frustrating for us, and we know it's just as frustrating for you guys because the way we see it should just be a standard transaction. The big thing, like Josh said, is that arm's length. Most of them are worried about an increase in price, and even when we show them the original purchase and sale, and the purchase price isn't changing. We've always said that you can't finance the wholesale fee or the assignment fee on a deal, and even trying to get that done without using the wholesale fee and the assignment fee in the financing, we're still getting a lot of pushback. There's a couple lenders who will allow rentals in a hold or an assignment, but they're very limited to a 5-year fix. So, if you're looking to do some sort of BRRRR, you're really locked in, and it's not a great solution if that's what you're looking to do. Essentially, what we've kind of come to the conclusion is just it's a lot easier to do a 1-year, B-side mortgage, get into the property, hold it for the year, and then just refinance on renewal and forego any exit penalties. Not trying to get out early. Just being able to refinance out afterwards into an A-side variable product, or if you're just a B client and your portfolio is a B client, on the B side they don't have any problems getting those assignments done. They can do them. There isn't any issues. there are some B lenders who have variable rates. They're not as competitive and as strong, but it does give you that longer term product with a better exit solution. You're limited to that 3 months exit penalty. So
yeah, there are some. There are two types of assignment deals. There are assignment deals where somebody's getting basically a turnkey property. Usually that's off to a builder. So an investor will purchase pre-construction condo, and that pre-construction condo will then be sold before closing. That person usually assigns a deal to somebody else. And now lenders don't have a problem with those. Well, there are more A lenders who are okay with that type of assignment clause. They just have to have some documentation from the builder, and we can end up figuring out as long as you debt service within your ratios. The second is going to be you're purchasing a property off of a wholesaler, and there's going to be two types of those properties. It's going to be a property that's not in great repair, so a property that needs some work to be done to it. And those properties usually are pretty beat up. They have the most opportunity to be able to force appreciate. So a lot of investors like those properties. So the majority of people who are purchasing those properties are purchasing it either privately or with a Schedule B bank. Usually most A banks won't have an appetite for the type of properties that are in disrepair. So that's why the majority of these wholesale deals get done like that. They're getting done privately very quickly with an open term to be able to refinance out when it's completed, and then trying just to find a solution, a takeout solution or a sale on the back end. Whereas the ones that are, you'll find very many people who purchase on the A side that are doing an assignment deal because it's in great shape already and they just want to hold on to it for cash flow purposes. If that is the case, you do have few options when it comes to what bank you can approach for that type of financing, which can be a little bit difficult.
Yeah, and I think Josh touched on it, but I just want to make sure everyone kind of understands what he said is, they allowed for a wholesale coming from a brand new build. So when that property is a brand new build and it's being assigned, the A lenders do allow that. So they are okay with that. It's on these resale type properties that they start to have an issue. So if you're looking to do an assignment purchase and it's a brand new build, that's going to be a completely different situation than these resale type properties where, they've been sold one or two times and are now being sold again, obviously. So keep that in mind. Those are two determining factors as to what the A lender is going to look at first and whether or not they're going to continue moving forward with the application.
Yeah, I mean, and 90% of, again, as I said, 90% of these wholesale deals are something in which someone's going to do a flip, and that flip is going to be a short-term financing. Unfortunately, most of these purchases do have some sort of acquisition cost attached to them because you are looking at either a B product or a private product. But when weighing the difference between a completely open term at, say, 2% in fees total compared to a closed term where you're going to pay some sort of interest rate differential, the numbers don't lie at the end of the day. So it's always good just to take a look at your options and know what's out there, especially when you're purchasing these not so conventional purchases.
Mm-hmm. Quick question. What's the largest line of credit amount we've ever seen?
Ooh. I actually my client just opened one. $650,000 was on top of his, obviously.
Yeah.
$600,000.
I guess that means if we're just looking at personal lines of credits, I mean, I've seen operating lines of credits that were in the millions, but personal, yeah, I think the largest I've ever seen was somewhere around like an $800,000. It was just a giant line, like HELOC. I've seen some pretty big unsecured lines of credits, though. I mean, I've seen some that are in like the $200,000 or $300,000 for an unsecured line of credit. But I mean, like it fits those types of borrowers. They have high income jobs, great credits. They're usually involved in some sort of trade as a builder or something, and they're obviously just utilizing that, to be able to either put tools on or something work related. But yeah, usually like I think personal $200,000 or $300,000.
Yeah.
Another question here from Shamir. Hey guys, I've heard that variable and fixed rates are impacted by different factors. Are you able to comment on that? Also, what are you forecasting for variable rates in the near future? Thank you. So you are correct. They are impacted by different factors. The fixed rate is impacted by the bond rate and the bond markets, while the variable rates are affected by the Bank of Canada overnight rate. So, two different factors there. Right now, we are starting to see fixed rates go up. I think TDs had two to four rate hikes this month, and some of the other banks, we started to see the rate hikes as well too. Variable rates haven't moved yet. In the future, we'll be forecasting. I think by the end of the year or mid year next year, we could be getting back to that 3% mark on the fixed. Variable rate, it's really tied to the credit, the credit facilities and the credit lines and keeping the credit markets open. I know we've touched on this a couple times, but when COVID first hit, their concern was just keeping the credit lines open and allowing for borrowers to be able to utilize those credit lines. As people were starting to get laid off or maybe losing their jobs due to COVID, and they just knew there's going to be a more heavy reliance. Banks have margins, banks are businesses. The lower that rate goes, the less they're making on their margins because they are borrowing that money to put it out. I think variable rates are going to go back up at some point. I think they just have to. Banks are going to want to start making their money, and it just, it doesn't really make sense for them financially to put money out this cheap once the economy kind of gets back to normal. So I think once everything's all said and done and we move away from COVID and hopefully the economy opens back up closer to 100%, I think we'll start to see rates back near the 3% area.
Yeah, I agree with there. And I think you're going to see higher rates than what the Bank of Canada has initially came out and said. The Bank of Canada is forecasting 2023 as having some sort of rate hike and having inflation start to actually catch up to what's happening with the economy. I would say probably low threes to mid threes by the end of this year or early next year. I do think we're going to have a very strong spring market, and the variable rates are going to stay where they are, which is going to obviously be advantageous to investors. But having an adjustable rate mortgage and having the ability to be able to maybe move to a fixed rate once you start seeing these rate hikes or once you start seeing the economy moving in a certain direction, might be a good idea. And I had a conversation about this the other day about an adjustable rate. So having a variable rate and then switching it to a fixed term once you start seeing fluctuations in the market. Now, obviously, you have to ask yourself, why are you in a variable term to begin with? Is it because you think overall you're going to save more money over time? Or is it because you want the flexibility of the product that it gives to you to access the equity in your property? So it might not make the most sense to switch to a fixed rate just because you're going to save a few basis points if flexibility and cost and prepayment is something that is part of your investment strategy. So all things to keep in mind when you're trying to choose either a fixed or variable product. And looking forward, I personally think that the Bank of Canada is going to do it very quickly. It'll be quarter point, and then maybe half a point, and they'll continuously raise the interest rates.
Yeah, like Josh said, it really comes down to what do you guys need and what are you looking for? If cash flow is your preference, obviously looking at the lowest interest rate is going to help with that. But if you put yourself in a variable rate and it has the ability to fluctuate, and we're coming out of an economic downturn and hopefully back to a more functioning society, and there's a possibility of those rates going up. Does it make sense for cash flow purposes to go into a variable rate when hikes could be imminent? Or does it make more sense to put yourself into a 5-year fixed and, just maintain that cash flow for the next 5 years? And if you're looking to do some sort of BRRRR and hopefully pull out some equity, keeping that 3-month interest penalty as a viable option by going with the variable route, that's what you need, and you're going to go with the variable. It really comes down to what do you need and what is your goal. I think we said this, almost every time we've done a video. It's just everything in real estate comes down to what's your goal and what do you need most. There is no real one fits all type product in real estate. You get one or the other. There's pros and cons. So just what do you need, and basing your decision off of that and allowing you to just make that decision moving forward. Predicting if you're going to be doing a refinance, and you're coming from a variable and rates are, 1.7, 1.8 for a rental property right now and a variable on the A side. at the end of the year, where's the rates going to be? You might be cash flowing now, but if rates are back up near 2.2, 2.5 the next year, just be aware that even though you have a great rate right now, hey, you may not be cash flowing in a year from now, or your cash flow might be cut in half. So keeping that, in consideration as well too, that's going to be a determining factor. No matter what your rate is now, a year from now, if rates are up or rates are different, your cash flow can be a completely different scenario.
Yeah, and the last thing you want is to be underwater on a product, on a building or on a property when you could have just taken a shorter term with that little bit of a higher interest rate and locked in to understand that you have consistency in your mortgage payment.
Mm-hmm. Something else that we wanted to talk to you guys about too was just a scenario that I ran into last week with a joint venture group, and having multiple investors on a property and then using that property to be able to move forward and buy other properties. Basically, there was 3 guys who were in on a project. They had a joint venture agreement written up. And then basically maximizing personal debt servicing. They had each individual member of the group buying properties separately so that they weren't tying up their debt servicing. You are going to run into a situation where the lender does want to know where those funds are coming from. Now, if you aren't on title for the property, you're going to have a very hard time being able to use 100% of the funds from that joint venture group and from the proceeds. These guys had a 33% ownership structure set up. And all we're really able to use right now is the initial investment that was given by the borrower. So the borrower put in about $25,000 and should have been able to have, as per the agreement, a third of the takeout, which put it around $35,000. And they only allowed him to use what he first put in, just because there wasn't any specific designation in the joint venture agreement that stated how much of the funds, a specific number. And that was really the issue for the bank, was that, there is nothing that tells me what he's able to use. It just said that he owns 33% of the share. So, moving forward, something that we're going to take a look at is, talk to some CPAs and talk to some lawyers and maybe talk to some of the lenders and just say, hey, how does this need to be structured for the JVs to be able to use, if they're a 30 ownership, how do we allow them to use 100%? If that has to be specifically stated in, the joint venture agreement, because obviously there's no way ahead of time to be able to designate a very specific number. So that's something that I would talk to, maybe a lawyer about how to structure that joint venture agreement and how the wording might affect it, and then talking to the mortgage professional. We're going to take a look into it and figure out what exactly those JVs need to say for each individual member to be able to use 100% of the funds. But right now, that's kind of the issues that we're having and some of the limitations that we're seeing moving forward with the JV. Outside of just all those JV members, again, being on title for the new purchase, obviously you'd be able to use the funds then. Obviously, the other way around that is just creating some sort of holding company and, being able to use those funds moving forward. Keeps your names personally off title, but again, on the residential side, you would have to continuously debt service each property that was in the holding company, and then any other properties that you had in your personal name, just because you qualify personally, even if you're buying in a hold co residentially. So we will definitely look into a better solution and keep you guys updated from what we hear back from the lenders and how we might be able to structure those JV agreements a little more efficiently.
Yeah, for sure. And I know that Sean was talking about having a professional write those up. So if you don't have a lawyer who can take a look at your JV agreement before you actually execute, I would highly recommend you do that. It would save you a lot of time and money and possibly qualification down the road.
Yeah, it's not as simple as just having a ratio or having something in writing. The lender is going to want to see something very specific. And again, anything that indicates that, those funds might be some sort of gift. Basically, if you don't have direct written entitlement to a specific amount, they might view or deem that as a gift. So again, just the importance of having a professional look that over and make sure it's specific to each individual setup and joint venture partnership.
Yeah, I think talking about kind of segueing into sharing funds. Then we touched about it on one of our old videos with Matt. But if you are purchasing real estate, say with with a partner and you go on title of that purchase, and then you want to purchase another property but not with that person, you have to debt service 100% of the cost of that property, and you can only use 50% of the rental income. So you can use 50% of your 50% of the rental income, which significantly impacts in a negative way your ability to be able to scale a portfolio. So just when purchasing property with people and going on title with somebody, but then not thinking 3 or 4 steps down the road we need to buy another property, it could be detrimental to qualifying for a property down the road as well.
Yeah, absolutely. Questions? No questions today. Everybody's out enjoying the sun.
Yes, keep it quiet, enjoying the day.
Market factors. Anything else that we could talk about? Forecasting. What other kind of changes have we seen? Just another update. I know we talked about this on Matt's live stream on Friday, but the lenders are just super busy right now. We just got word that some refinances are taking up to 3 weeks to just get approvals and commitment letters back. Lenders are just notorious for putting refinances off unless it's specifically tied to some sort of purchase or something immediate. Refinances get pushed to the back of the line. And right now, just with the volume of purchases that are coming forward, refinances are just kind of taking a back seat right now. Again, it depends on the lender, obviously, but the MCAPs and the First Nats and the more top tier lenders, they're really getting hammered right now. And times are slow. Underwriters are taking 72 hours to turn around documents and get back to us. So if you're looking to close in 30 days and, each time we have to submit an increase in a new document, that's another 3 days that it's going to take for that lender to get back to us. So, that quickly eats up weeks at a time. And that's part of the reason why we ask for all the documentations up front when we do our initial application. Once we get all those documents up front, we do one submission, and then, 90% of all the documents have been up front. And if there's anything else a lender needs to see, then, we can come back and get that. But I know sometimes we get questions about, hey, why do you guys need all these documents? Or why do you guys, do you really need all these right now? And some of the documents we may not necessarily need to underwrite the file, but if it's an underwriting guideline of the lender, it's a lot quicker for the process. And we already have that document on file and we can just submit it versus submitting all the documents, waiting a couple of days, getting an answer back from the underwriter, and then having to request that document from you. Maybe you're busy, maybe it takes a couple of days, next thing you know, a whole week has gone by, right? So that's why we do it. That's why we collect the majority of the documents up front. Helps us with the underwriting and making sure the numbers are accurate, but it also just helps us ensure that we're more efficient when we're submitting the documents in, and it's one less time that we have to go from the lender back to you to ask for documents to make sure we're all good.
Yeah, for sure. Having everything up front definitely expedites the process, or expedites the process, I guess, depending on how you say it. We actually we're working on, I don't know if anybody saw our post yesterday, we're actually working on a real-time tracker for our clients. So what's going to happen is on the back end, as you move through the process, you're going to have a real-time update portal that you could go to check as to where you're at in the process and what to expect moving forward. It's something that we've been working on for a while now. We had to obviously have our developer team work on creating the solution that we thought would be beneficial. So it's almost done. It's getting there, but we're excited to have it rolled out hopefully by the start of Q2.
Yeah. We know everyone's curious as to where they are in the process, especially in the busier times where we may not have as much time to kind of touch base with our borrowers on a day-to-day basis. Having, you guys having something that you can go on and just check and see what stages you've completed and what stages you're at, at least lets you know where you're at in the process. And, hey, some of the processes take 3 to 5 days. Excuse me. And if you have that notification, at least hey, I talked to them a couple of days ago. It says it might take 3 to 5 days. You're within that timeline. So just trying to keep the customer service as high as we can. I think that's the biggest thing within the mortgage industry, and the biggest complaint that we hear is just, brokers not being able to give the highest customer service. And there's times where brokers are just super busy. Months like these and moving into the hot months, it's when you have a lot of timelines and just a lot of borrowers for financing. It's a little bit harder to touch base with everybody every single day. So I mean, keep that in mind, and give your brokers a little bit of a break sometimes. But just understanding the market and where we're at. The hot markets are busy, they're hot. It's a lot tougher to get in touch with the underwriters. There's a lot more communicating that we're doing with the bank, and a lot more hands-on that we're doing with the banks, because if you let the lenders just sit there and move at their own pace, then we'd rather take control of the situation and be more hands-on and make sure things are getting done in a timely manner. So, but we're trying to make sure the customer service sticks around and is at a level where it should be.
For sure, yeah, we're really excited about rolling that out. You guys will be the first to know. We did get a question in from Dwayne LaPierre. He said, "Hey, Josh and Aaron, can you tell us more information about amortization terms? What is the maximum length of time for an A lender and a B lender looking into improving my cash flow?" So, good question. For an A lender, there's two types of mortgages. There's uninsured and insured mortgages. So an insured mortgage is going to be on a purchase. That mortgage can be 25 years. You can't have more than 25-year amortization with on the residential side, I believe, with a insured mortgage.
Insured, yeah.
Yeah, I know. No, 25 years. But if you are looking to take advantage of that 30-year term, you can have an uninsured mortgage, which means essentially you put more than 20% down, or you refinance your property. You can bump that amortization out to 30 years, which will help obviously reduce your overall monthly payment. On the B side, they take advantage of longer amortization periods because all of their products are uninsured. So you can go 25 years, 30 years, 35 years. And there are some mortgage investment corporations out there that will amortize up to 40 years. So taking advantage of that is definitely a bonus. But those solutions do come with overall broker lender fee costs. So when you're factoring in the overall monthly payment and saving money monthly versus the cost of being able to complete the transaction, it may not make sense, just depending on obviously how large your loan is and what options you have available.
Yeah, and if you put 20% down on the A side, it doesn't mean you have to go with a 30-year AM. There are some borrowers that we get that still ask for a 25-year amortization. And there's something called an insurable type mortgage. Some lenders do it for the rental properties. Some mainly just do it on the primary occupied. But you can put 20% down and choose to go with a 25-year amortization. Or you can choose to go with a 30-year. Typically, there is a rate increase when you go with the 30-year. But that is offset, usually by the 30-year amortization. Even with the higher rate, most times that monthly payment is still a little bit lower than that 25-year amortization, even with a lower monthly interest. On the B side, like Josh said, you can up to 35 years, and there's some institutional mix and stuff. We'll do the 40-year AMs.
Yeah, and usually the mortgage investment corporations, a lot of them right now, the play is to have a really low carrying cost. There's a handful of ones in the market right now, especially in Western Ontario, that offer like 3.99 or like 3.5% on a rate, but they're charging between 2 to 4% in fees for acquisition, and it's a 1-year term. So it's the step before private financing. It allows you to have a decent carrying cost loan in an amortized way to be able to make a little bit of payment to your actual principal amount, although the overall cost for these solutions are much higher than what a B option would be. Specifically because the ratios, I believe, are up in the 60s, and they have more aggressive offsetting programs than what the Schedule B banks are offering.
Yeah, they're still usually a short-term solution, maybe 1 or 2 years. It's not something that you want to continuously renew into. The renewal fees alone can be a few $1,000s. So it's typically a entry solution, a short-term solution, not something that you guys would want to be in long-term. Another question from Shamir. You guys touched on this, but when you have joint properties and you have to debt service 100% of the property to qualify, what is the best way to qualify without the last property weighing you down? I mean, just, making sure the rental income is there. There's not a whole lot of factors that you can specifically control on a property when you're purchasing it. You can apply for the best rates. Based on your debt servicing, you may not qualify. Based on your credit score, you may not qualify. So I guess, just taking a look ahead of time, talking to your mortgage broker, having them look at your application, taking a look at your credit scores and figuring out what the requirements are from the lenders. That'll definitely help moving forward. But I mean, the biggest thing is just making sure that rental income is there. You can't change property taxes. If your tenants don't pay for the heating, you're going to have that heating cost in there. If it's a condo, guys, condos are easier on the eyes on purchase price, but as soon as you add that condo fee in there, a lot of time it really does kill a deal and it really reduces the cash flow. You can't do much with those fixed costs, but just making sure your financial situation is in a position to get the best rate and maximizing the rental income.
I agree. I think that if you had somebody that you purchased a property with and that specific piece of debt is weighing you down, either have a conversation about purchasing the other property with them so you can both take advantage of splitting the overall cost of the property as well as taking on all the income, or you're going to have to add income in your application. There's no real way to get out of the overall carrying cost of the property. Just because when you sign on the dotted line, you sign for equally and wholly the total cost of the property. Whether or not your partner pays, you're still responsible for that payment as well. So I would say add more income to the file. You're going to have somebody co-sign and purchase another property with you to make it work. That's why we sometimes see couples who look at investing in real estate, doing it by themselves and trying to stretch their personal qualifications, because down the road, when you're looking at a B lender or an alternative option that allows you to offset, you can use all that rental offset, and it's definitely beneficial to not have to take on more debt and to use more income. So there are pros and cons to obviously purchasing real estate by yourself or purchasing it with a partner. But if you are going to purchase it with a partner, make sure that your plan involves them throughout the process.
Yeah, if you're buying with some sort of joint partnership on a property and it's personal names on title, unless you're planning to continuously buy with that same person, it really isn't an efficient way to be able to maximize your portfolio, simply because of that minimized rental income usage on the property. I mean, realistically, the best way to do it would be to have some sort of joint venture, sort of like a holding company, and have those borrowers on title there and utilize it that way. Or you're going to move some sort of small business line of credit, but some business lines with credit unions, they utilize just the debt servicing of the actual buildings and assets themselves. In that sense, they're not looking at other properties on the portfolio. They're just looking at that one property. That might be another way to go around. You do limit yourself at 75% loan to value, 25-year amortization, but some of the credit unions just look at that one building. Now, that being said, there are some credit unions that on the small business side take a look at everything. Meridian is one of them. They'll take a look at the whole portfolio, whether that's properties in a holding company or properties in a personal name, and they want to make sure that it's still all debt services to a specific underwriting guidelines that they have. So depending on which lender you go to, they're going to do it one of the two ways, but that would really be the second option.
Yeah. I think factoring in, obviously, there's a handful of things you got to factor in when you're purchasing property with other people, but just keeping all those things in mind. It's stuff we see all the time that, unfortunately, hindsight's always 20/20, so you never think about it until you're already in it and you have to deal with the situation. And the solution for that situation is either purchase with somebody or you have to sell the property and then use the funds and go purchase something yourself, which obviously isn't always the best option.
Yeah, I mean, I think just due diligence up front. What is my maximum qualification already? What is it going to be if I can only use half the income? And then just trying to maximize, like I said, maximize the property. Find something that doesn't have, especially condos. If you're buying a condo with someone, you got to utilize that condo fee. You're definitely going to have trouble utilizing strong cash flow from that property. So just keep those factors in mind and do the due diligence up front.
For sure. Well, guys, I hope you guys are enjoying your Sunday. It's absolutely gorgeous outside. The golf season is coming. If you guys have any questions, obviously, about what we spoke about today or throughout the week, feel free to drop a comment below. We're always happy to help. I think we're going to sign off on this Sunday and get back to work tomorrow.
Yeah, as always, guys, if you guys have things you want to see us talk about next Sunday, just leave them in the chat, and we'll make sure we touch base on them next week.
Yeah, thanks, guys. Take care.